partner, my boss, if you will, Sandra Brown. Hello, Sandy.
Good evening, everyone. This is Sandra Brown with Mortgage Alliance. I'm here to talk about Alt-A mortgages. But before we get to that topic, today is a very important day whenever you come from a family of military people and just being Canadian and that whole proud moment of being Canadian. I like to take 2 seconds, Reno, just to thank all our military professionals who protect us. If it wasn't for them, we wouldn't have the freedoms we have today.
Thank you for your service. And I'm not trying to make fun of Don Cherry, but you people need to wear that poppy. I know it's today, so it's a little late now, but that poppy represents respect for those folks. And I'll tell you what, they're the reason we walk around the way we do. We're proud and we're free. So, speaking of being free, and that's what I want you to be. I want you to be stress-free, worry-free when you're talking about mortgages. I want you to be totally relaxed so that you understand what it is that you're looking for and that you understand the terminology and how to be part of that conversation with the lender that you're talking to or the broker that you're talking to so that you feel comfortable. A lot of this stuff is a trust-based conversation that you're having. And unless you feel trusted or trust that person you're talking to, it's hard to open up.
So the topic today is going to be what Reno calls an Alt-A mortgage, and what the hang is it?
Okay, so
he makes it convoluted, absolutely convoluted. It is not that complicated, Reno.
And it's not going to be either. It's just going to simplify things. You know my expression. My expression is in Ontario, there is a mortgage for everybody. And I truly mean that. It's just a matter of us fitting you together with the right lender, the right style of lender, and you understanding what it is. Here, let me give you an example. If you drive a Chevrolet, and it's got 15-inch tires. However, Canadian Tire has got 18-inch tires on sale for $1. Okay, you drive a Chevrolet with 15-inch tires. So why would you think that the dollar tires are going to fit on your car? They don't fit. So everything has to fit in the mortgage industry. And fortunately, most of the time, it fits for you too. So you decide what it is you need. We figure out who we're going to take it to. We put together the package and we go on. But there are cases that you could be approved. You could go on to have a mortgage. You could go on to own a house, but we're pitching up the wrong tree. So we're pitching in a bank style lender, CIBC or somebody like that. We're pitching them for you. And you're not that kind of customer, perhaps. And so that's why tonight's topic is very, very, very important to you guys. I like to call it the Alt-A mortgage or the Alt-A customer. And Alt-A simply stands for alternate A.
Not that what does it mean exactly? So you're saying Alt-A? Who cares? They don't care. They just want to know that they're getting their mortgage, and they want to know how they get their mortgage. It's like
but I had an interesting conversation today. You see, let me give you the conversation I had today. I won't.
You can't mention family members' names.
It's a family member of mine. So he should think what I'm talking to him about for weeks and weeks and weeks is true and understandable. But you know what? I'm not going to go into details. But and by the way, no secrets hidden. Always conversation. Always start about rates. And so that's what he did. He called me up today and he said, well, what's the best rate? I told him what my best rate was and our best rate was. And I said, and I knew because he doesn't ask questions unless it's already a loaded question. So I said, why do you ask? He says, well, because I found a website that is the best website in the world. Well, you know what? Right off the bat, he's offending me by telling me somebody else is the best website in the world. But okay, that aside, that doesn't make him a bad guy. He said I had everything on there. And he says, so here's what I want. Here's what I want to do. I want for a family member, I'm going to buy a $600,000 house. We're going to put like almost $200,000 as down payment. And I want the 1.35% that other website was offering. and my answer was, really? You want me to fit those parameters and you want 135? You need to go there. you need to go and get that mortgage at 1.35, stand in line for 2 or 3 weeks until they call you, and then wait another 8 weeks until you actually get it done. But that aside, okay, it always starts, even these Alt-A or alternate mortgages start with a conversation about rates. Rates are,
Right.
these low rates are reserved for, listen to me, don't cut in on me now.
You're stuck on the rate, and I know you're agitated by family members telling you how to do your job, especially when they've had no experience in the mortgage world. But let's get on to topic here. There's just different types of alt mortgages, and that's really what it is. There's the bank mortgage where they have a strict criteria. They want you to be able to work 9 to 5. They want you to have a salary. They don't want you to have even one late moment in your credit. They want you to be the pristine credit score. That's like the A lender. But we don't want to
They
talk
want you
about
to
those
only
guys.
put in 5%.
Oh yes,
Okay.
it's 5%. That's it. Because people don't understand. You have to have if you have more than 20% down, you're not getting that bottom rate. You're just not getting it. That's the way they work it, because they're protected whenever you actually get insurance. When you pay for the insurance because you put less than 20% down, the lenders are protected, so they're going to give you the better rate. But there's more to that rate. Don't give up just because you've gone in and they said to you, well, we can't confirm your income. So no, you're declined. You can't get a mortgage. That's not true. That's definitely not true. We have it all the time, Rena. We get them coming to us. They're just dejected, or sorry, feeling rejected and like getting kicked up, but they work hard and they just want to own a house. And they come to us and they're going, how come I didn't meet you before? Well, because you went to your bank.
Okay, so let's go back to reality again. And this is not about my family. This is about generalities. So if somebody wants to buy a $600,000 house and they make $40,000 a year, you're not going to qualify for a $600,000 house. It just doesn't work. The numbers simply don't work. So not only is the 1.35 or whatever rate that you saw advertised or coming out of my lips right now, forget that. You don't qualify for it. You wouldn't even qualify for the house. So you need to either get somebody else on there with you to, instead of 40,000, to have an 80 or $160,000 income or whatever the new income is going to be, and then you qualify for the low rate, or you need to be thinking in terms of alternate lenders who are going to help you out. Alternate lenders who may not be as picky on your ratios. They may not be as picky on your income. They may not be as picky on the documentation that you have to provide. And by the way, there's a lot of documentation that all lenders will want to see. And they're just trying to protect themselves.
Well, yeah, because they don't have anything else protecting them. This is the only way they're protecting themselves, is by getting the proper information from you. So yes, you're not going to get the 1.37 rate. That's true. Like, you're not going to get that bare bone rate. It doesn't matter. But what you will get is that mortgage of your dreams. That's what you're going to get. If that's what your goal is to own the house. The reality is, if you're not declaring your income, it's really on you.
Listen, there's some like in any other industry, in our industry, there are some mortgage brokers that don't know what they're talking about. 2, are scumbags, just like there would be in some other industry that are trying to scam you.
Every other industry has it. Every industry has it. Not
every industry has it.
Yeah.
But when you're talking to somebody who's been around for a while, who works for a reputable company like Mortgage Alliance, which is what's the largest in Canada, so that's pretty reputable, and they haven't been fired yet, and they're still trading under that banner, probably what's coming out of their mouth, as long as they've got some experience, you should trust it. And so it always goes back to listen to the mortgage broker. Don't go in with preconceived ideas. Here, I'll give you another example from a few days ago. And you know how everybody is about credit score. Oh my God, I got, oh my God. Well, first off, most of the conversations we have are people who have under 620, under 610 credit score, which overall, gosh, it's close, but no cigar, because the lender, even though the insurance company will give you or back the lender up, the lender doesn't feel comfortable, so they're going to say no. So we have to go through a bunch of different lenders in order to get to you. But let's go here. So I've got a customer who's got an 800 plus credit score, which is just, it's cream of the crop. Guy has a job. He makes $200,000 a year. unfortunately, he carries a lot of debt. He's got a couple other rental properties. He's got 6 or 7 cars. He's living the life of somebody who's making a couple $100,000 a year, plus another $100,000 worth of rental income. So he's making good money. Guess what? He doesn't qualify for one of those 5% down mortgages, or the rate for the 5% down mortgages. So it doesn't mean that we're trying to take advantage of them, or that the world is trying to take advantage of it. It means that we've got to go fit and find the fit for that customer with a different lender. And that lender that we had to go to was someone who had expanded ratios. So rather than the 35-44, I know this is boring for you, but the 35-44 standard ratios that most lenders will qualify you at, the lender that I'm talking to had 60-60. So you can go up to 60% of your income as the spending ratios for how to qualify. So there are other lenders out there.
Let's not even talk about ratios. Let's talk about properties. I just had a situation this week where the woman had great credit. She had good guaranteed income. Her ratios were 32, 35. Like, there were nothing. The lenders, the insurance companies did not like the house. So she could not get a mortgage. I took that property to probably 10 lenders, and every one of them went, nope, don't like the property. No, don't like the property. It's when you find that right lender who knows the property, because they actually do the mortgage on it once, they go, yeah, okay, we'll give it a shot. So that doesn't necessarily mean that she's not an A customer. It just means we have to take her to a alt, that the rate is not 1.37 or whatever that low rate is. It's not, because it's a higher risk property, because where it's located and the size of the property, it's harder to sell. That's what these lenders are looking at. How hard is it to sell? And the rates are going to be based on how hard that house is to sell. What is the risk? And that's what they mean by alt A's, is what risk is associated with this mortgage. So sometimes the risk's too much. You're not an A customer. You're an alt A customer.
There's nothing wrong with that. As a matter of fact, most of the customers, and try and understand this because it means something important. Somebody who has a great income, the appropriate down payment, and has the right ratios to buy a house, generally buys one house. So we're not really talking about that person. We're talking about the person who doesn't quite fit the mold of that one person. Maybe you've already got 5 or 6 rental properties and you wanted to buy that 7th rental properties. Well, your ratios aren't going to work. So that doesn't make you a bad person. I mean, you got a credit score of 850. You've got, you've got a net worth of $1 million+. So there's nothing wrong with you. It just doesn't fit the lender. Just like this little house of Sandy's was also a very small house that the insurer didn't like. Okay. So there's so many things that could make it an alt A situation that we could go on for 3-4 hours about, leaving yourself open and thinking about, if you can't get a nice, easy approval the way you'd like it, leave your mind open in order to be able to take it to the next step. Rates are generally right around the same. Maybe it might be a little more, but then remember, you're not at that 1.39 because it's not insured.
I'm glad you're bringing that up. So yes, the rates sometimes with some of these alt lenders is a little bit higher. They're not at that 1% or whatever it is as of today's market, right? But the reality is, as soon as you hear the broker say, and they charge a 1% fee, everybody says, oh my God, a 1% fee. Oh. But whenever you're coming in with less than 20% down, okay, so say if you're putting 5% down, you actually pay the insurer a 4% fee to insure your home so you can get that low rate that you've been wanting. That's what people don't realize. Whereas when you're getting this here one that's not insured by the insurer, that you're getting to able to get a mortgage of your dreams or to buy the house that you want, and you don't have all the proper information, you're paying 1%. So you're actually getting a discount on fees by going with the alt lender.
Let me bring that out in real numbers for you, because that's the one that's freshest in my mind from this afternoon. So on a $600,000 house, if you were going in with anything under 19.999% down payment, you're going to pay that insurance premium added to your mortgage. And in that case, it's $24,000. It's 4%. So $24,000 would be added.
You're a little bit off on that one,
5% down payment. It would be
5% down. Yes.
Yeah. So that would be an added $24,000 to the mortgage. So right off the bat, you're upside down by $24,000 because it's an insured mortgage. Look at that. I've got an underwriter calling me at this time of day. That's how good these guys are. Let me hang up on him. Yeah, he's watching the show and he's wondering who that $600,000 customer is. Anyway, so on a $600,000 mortgage, 5% down means that they're going to add $24,000 insurance fee. Okay, that's just to satisfy the lender that if you don't pay, they're going to get paid by the insurer. However, if it's an alt lender, they may charge a 1% fee, which on $6,000, guess what, is $6,000. Yeah. So that's a huge discount off of the $24,000. And so when you put it into perspective, say, number one, I saved $18,000 to start with. So yeah, I'm going to pay 0.25% or 0.5% more on the rate side. Wait a minute, let me do the math. Or call Reno and Sandy and say, Reno, Sandy, do the math for me. Show me in real terms how much I'm saving, how much I'm losing, and I'll warm up to that alt A.
And there's even more than that, though. There's even more to that, Reno, because you're taking that 4%, right? We're based on 5% down. You're taking the 4% fee that the insurer charges you. You're amortizing it over 25 years, so you're paying interest on that money. Whereas most lenders, they'll take that fee up front, the 1% up front, and you're not paying interest on it.
You know, it boggles my mind that people buy, or not buy because they don't buy, but they convince themselves that that's what they want to get into. And unless I get that, I'm not going to take it. I'm not going to take it. Just because somebody told them it wasn't somebody that doesn't know anything about mortgages told them it was, oh, better yet, you told yourself because you were looking on the internet at all the things that the reason you shouldn't take it. Let me give you another perfect example in real life. Okay, these glasses that I'm wearing are starting to get old, and so I ordered some. Great company online. The glasses were here in 72 hours. I'm talking beautiful. From the time I ordered them until the time they delivered them, 72 hours, and it was $300. Okay, so there's your cheap rate discount. Yeah, nice glasses. I put them on. They were beautiful. I'm handsome anyway, so it kind of
okay, yeah, that's it.
Enhanced what it is, or I made the glasses look real ugly. Anyway, so I wore them for a couple of weeks, and I couldn't get used to them. And I finally figured out after 2 weeks that when I'm looking straight ahead and I'm looking to the left or the right, the image changes on the left or the right. Okay, so I sent them back. So I called up, I asked, can you fix these? And they said, well, we don't fix, just send them back. So I sent them back, and I went down to the person who had looked after our optometrist. So they have a glass shop there. And I spent the same day, I sent back a pair of $300 beautiful glasses. I spent $900, more than $900. It was $900 plus tax. So I spent $1,000 on a pair of glasses simply because I spoke to the person who knew what she was talking about. Because as soon as I said, hey, listen, I can't see, to the either side. And they said, well, that's right, because your prescription is made different. Well, that's an alternate. If you compare it to us, that's what alternate mortgages are all about. Let's get you the product that you need. And yes, rather than spend $300 like that 1.35 interest rate that was out there somewhere.
And again, that $300, it did not give you that hands-on, touchy person that I know that when we have problems with our glasses, we're going to walk into our store. We're going to say, hey, we're having a problem with them. They don't fit right. They're going to adjust them for me, and they're going to get them right for me. Whereas when I'm doing it online, especially with glasses, like clothes is another story, but with glasses, you need it properly fit. So with a mortgage, you actually need a mortgage fit for you and your needs and your family, because you could be buying into something that totally is not going to make sense to you. I get clients all the time. We talk about this all the time, where they say, oh, I want that 5-year fixed rate. Well, you're telling me, though, that you're selling this house in 3 years because you're going to move somewhere else. Why would you do that? Why would you put down 20%? Why would you do that? Because, again, these alts, sometimes an alt A is the better option for you.
It really is.
Yeah, because you can take it with an alt A means you can go 30-year amortization. So that
Well, 35, we have one lender that'll do 35. So
we
if
actually
your
have some
goal
that
is to
do-
keep the payments lower, we extend that amortization to 35 years,
So
and you're
that-
a bit lower.
that customer you have that has all those rentals, if he'd just gone with a 35-year amortization with a lower payment, he probably would have qualified for that new mortgage with all that
Absolutely.
extra debts. Absolutely.
Absolutely.
And
And again, these alt A's, not a bad thing. They're A's, but they're just alternate, right? Just a little bit off. It helps you to qualify for more mortgage. Obviously, if we can extend the ratios from 44 to 60, you're going to get a whole lot more buying power. And that's what this, and especially in today's environment. I hate to tell you, because we've had this discussion before where I get really disappointed for people making good money, 60, 70, $80,000, good money in anybody's economy and anybody, good money per year, great credit, everything's good. But the market that they're living in has $600,000 houses. That's where they start. God, how do you buy a house? You can't afford it. You cannot qualify with conventional lenders. You just can't do it. The numbers simply don't work. And the lender doesn't have, I don't know why, but doesn't have that.
don't mean conventional lenders, Reno. You mean conventional insured, like you don't qualify for an insured mortgage because the insured means extra guidelines that we have to follow.
Well, remember,
It doesn't make it bad or good, or it's irrelevant. It just means that there's certain criteria whenever you do an insured mortgage that you must follow in order to get those great rates. And sometimes you're just going to fall outside of that.
So $60,000 income, 5% down payment on a $600,000 house does not work. It just doesn't work. It doesn't matter what you do. It does not work. Now, all of a sudden, if your mate or your partner also makes 60, that's 120. Now we're getting to the part, and 5% down. Now we add, if we had a government grant to that with making it a 10% down payment rather than the 5, then all of a sudden you're getting closer to that 600. You're a lot closer to that 600. So it's little things like that that fit. But for the alternate lender here, we're talking people who have a good size down payment, have good credit, have or not, maybe marginal, but can have good credit and simply don't fit the mold that it takes for first-time home buyers.
And
That's all.
More and more in this alt, it's actually becoming more of an alt environment in reality with the high pricing market, with the crazy market that's going on these days. It is affecting buyers, especially young buyers who have decent jobs. They just don't make that $100,000 a year income yet. They're just not there. But what we're also seeing a lot of in this alt A market is parents and children buying houses together. So that basically the child is going to live in the house and their parents are buying it with them just to help them get into the market, because the market has gone insane for at least in this part of Ontario, Eastern Ontario. Absolutely.
So remember, big deal about alt lenders is that they have that flexible debt to income ratio that is key. It gives you more buying power. And so you can make a little less income, you might not be see, the other thing about A lenders is that they want documentations 110%. Some of these alt lenders will accept a little less documentation, so they're a little easier to deal with. But you got to have some skin in the game, and they want you to be serious about it. But it gives you much more buying power. It also opens up a whole different part of the market. And the reason I'm saying that, not all lenders, not all, but the 1.35% lenders have an alternate side. So as soon as you fail there, you feel like the whole world has abandoned you because now you got a decline. You can't go anyplace else. Whereas the brokers that you're talking to, we all have access to the A lender. So we would take you there first, obviously, if you qualify. And then number 2, with your permission, we would also open it up to alt lenders who you would qualify for, probably, depending on the numbers, and we'd get you into a house. So we have the flexibilities because not all A lenders or bank style lenders have an alt A side. They just don't want that business. Remember, the banks, especially the big 5 banks, all they want is the cream that rises to the top and stays there. Even if you float down a little bit, they don't want you to. You have to be right at the very top, and that's the only business that they want. So go and see someone like a mortgage broker that you trust, to speak to him or her about this kind of situation.
And I think, you know what I think is really important, how to determine whether that broker is somebody that you can really, really trust. If that person is really dodging your phone call for 3 days or a week, is it really somebody you want to be working with? I think
banks don't call you back for 2 weeks.
I know, and I don't understand that, because I have clients. I actually have a client, he calls me just to test to see if I answer the phone. And he says, look, you actually do answer the phone every time I call. And very rarely, it's actually kind of annoying. I have to shut my phone off here in this meeting because of the fact that if my clients call, I will answer the phone and interrupt this meeting. So I have to shut it off in order to respect Reno's time and get this done. Not that I respect his time a lot of the time, but in this case, I do. And you really got to have that open relationship with your broker. If you're trying to hide things from them, you can actually be affecting where we take you, whether it's A or Alt A. We want to get you the best rate there is. We're always going to fight for you to get that best rate. We don't want to just throw you into an alt lender or a private lender just because.
And by the way, we should be taking you to the big 5 banks, or anybody else who deals only in the cream of the crop business, because they pay us more. So when we take you to an alt lender,
that's true.
Generally, if they're paying us, we get paid a lot less. Remember, they're not making as much on you. That fee, it wasn't 24,000.
No, I don't think it's that. I think it's because they know that you, as a customer consumer, you don't have as many options anymore. Whereas whenever you're an Alt-A person, you've got all the options in the world. I can go here, there, whatever, it doesn't matter. But whenever you're an Alt-A person, okay, you probably have a 575. There's a possibility you have a 575 credit score. Hey, the bank's not touching you. So it really reduces all those people that will lend to you, especially in your area. And if you live in rural areas, it's tougher to get alt lending.
Well, absolutely.
Rural, because we live in areas in Ontario where there's nothing for miles. And there's houses in these areas. I had one that was like an hour away from any city. So that makes it tougher to get lending on the alt sides, but it doesn't mean you can't. It's just going to be affected. The rate's going to affect the more rural the property, the rate's going to be higher.
Yeah, well, it makes sense. There's a word called marketability in the mortgage business. And remember, I mean, even though we don't lend based on the fact that we want to own that house. Nobody does. Okay. We want you to own that house. The lender doesn't want to own your house, doesn't want to repossess and have to sell it. That's the last thing they want to do. They deal in money. They don't deal in real estate. So marketability becomes important. And if you stick a house in the middle of the woods with a septic tank that doesn't work and a well that is artesian or maybe just a surface well, it becomes a lot less marketable than something in downtown Kingston or down Toronto or Ottawa. Because the ones in Ottawa and Kingston and Toronto, they're going to sell in a couple of hours. That's how quick it is. And they want the money. The lender at that point will want their money back. So marketability becomes a key factor.
It's the most important part. It is the most important. And then you've got other variables. But whenever you're going alt, a lot of the barriers you had up to that point have disappeared. Again, it depends on all that stuff. It's not just one solution for everybody. It's let's find the right solution for you. There is solutions out there.
Right. And when you walk into your bank and you say, well, I don't know why, but you decline me, that because there is some of that conversation going on. And you say to them, well, how about you taking me to the alt side? It doesn't exist. It does not exist. It simply doesn't exist. There's only one thing that you're going to get from a bank is either approved or declined. One of those two things is your answer. And hopefully it's approved. Now, if it is your desire that you have to go to the bank and you feel like, remember,
Reno, let's go back quick. I worked for the bank.
Yeah.
And reality-wise was that if I couldn't do the deal, which a lot of time we couldn't, we send them to a mortgage broker. This is where we sent them, was to a mortgage broker to get the deal done. So how about cutting out the middleman and come see us, your mortgage broker?
And here inside the bank. So when you're one of those specialists inside the bank, one of the commands from up above, and I'm talking the big banks, is we do not send business to mortgage brokers. So imagine what kind of an attitude that starts with. So you're going to decline your customer, and you're basically going to make sure that they're homeless because you're not going to send them to the name of the mortgage guy who's around the corner who you may or may not have a relationship. So please, please, you're here for you. Look after you. Come to us and we will help you look after you. We've run out of time again, guys. So unless you got something to say last minute, Sandy.
No, that's pretty much it. Again, I just want to say thank you to all our soldiers, Canada, US, all over the place that have fought for our freedoms. It's just great being here. I love this job.
For me, I love you guys, every one of you. I need you to subscribe, and that way you'll get notification of when we're on with new product. Until next week, I'm Reno Viola, and
I'm Sandra Brown. Have a great week.